ISM contraction hasn't really made you change your targets, at least for this year and next.
No, so the big questions on a lot of portfolio managers' minds relate to the inverted yield curve, the ISM contraction, questions about the trade dispute with China. On the other hand, the ISM services non-manufacturing survey was actually pretty strong, steady at like 56, so basically indicating the services side of the economy, which is frankly more important in overall context than manufacturing at this juncture. And then there's some expectation that perhaps there's some hope for trade negotiations, some discussions that are taking place. I think the market has seized on that a little bit, and the market is now roughly sort of 29.75, and our price target for the end of this year is 3,100. So that's about 4% above where we are today. Pretty much in line with the idea that the economy is still growing modestly, and that would be consistent with a little bit higher earnings for next year.
Yesterday's, it's one-day move, but the shift in momentum, the way in which some of these long-forgotten energy names have come back to life, you think that's a sign of something?
Well, I wouldn't necessarily take one day as a trend making, but we look at some of the fundamentals as to where the economy is going, and some of the technology companies still remain growing, more of the services oriented in terms of subscriptions and software as a service, which there's some visible revenue growth. I think is a key attribute that portfolio managers at this juncture are really looking for in an uncertain environment. If there's a debate about whether this downturn is going to persist or whether the economy is going to continue to or may recover or in terms of accelerate, that's been a debate. Where do you find investment opportunities? So it tends to be where there's more visible revenue growth. Some of the longer-term contracts, you look at the defense area, for example, almost all the revenues coming from the U.S. government. Those are areas to focus on for us.
You're really looking at elevated consumer spending as one of the big drivers for the economy. And yet when we look at the non-revolving credit, it rose to a record high, more than $3 trillion. You've got household debt, excluding mortgages, now to the second most high level since August of 2016. Do you have any concern that the consumer is just stretching too thin?
Look at the consumer. 70% of the U.S. economy is the consumer. So clearly that's a vital issue to focus on. So you have unemployment at 3.7%, the lowest in 50 years. Wages are rising, 3.2%, latest reading on Friday. So that suggests that there's some real wage inflation, real wage growth, which is a positive. And consumer balance sheets are actually among the strongest they've been in a decade. There's been deleveraging going on. So in aggregate, you can look at the numbers, but when we think about it in terms of the coverage ratio, in terms of their household financial obligations, it's actually quite in a comfortable zone from our perspective. On the corporate side, leverage has come up a lot, and that's perhaps more of an area of concern as opposed to the consumer.
I want to get back to this idea that Carl was bringing up the last few days in the marketplace. We've seen this dramatic reversal in terms of what at least investors want to own, or some, which is now value and dividend paying stocks seem to be in favor suddenly.
Right.
And it's been a violent move. Do you think that's something that's going to sustain itself? And we're watching some of these momentum names. Take a look at Roku, for example, over the last couple of trading days, really decline. Is that sustainable? Is that a sign of something?
Well, so the 10-year Treasury yield now is down around 1.5. Well, it's been fluctuating between kind of 145 to 160 basically in the last couple of weeks. So in that environment, with those level of interest rates and the expectation that the Fed is going to be cutting rates, my colleague, at Goldman Sachs, we're looking for a Fed cut in September and then another cut in October. That leads to an attraction for the dividend yield stocks and stocks that have yield, perhaps yield and growth, the combination of those. And those would be the argument why that is becoming more in favor. There's a desire for income.
Well, do you like value and dividend payers more than you like growth right now?
No, I prefer to own as a portfolio. We prefer to tilt towards growth. The idea the economy is continuing to grow, not at a robust pace, but at a modest pace, would tilt towards growth stocks outperforming. That's one of the reasons, and Jim mentioned earlier, we did this analysis of all of the initial public offerings done in the United States in the last 25 years. That's 4,500 companies. One of the reasons there's such a focus on the IPO market is because the opportunity set for perhaps faster growth in some cases.